Okay, ladies and gentlemen, welcome back to our second segment uh, in our lecture for accounting for inventories. All right, as I've already indicated, please feel free to contact me on any future lecture series, or if you feel you need to start with us. Uh, We are Transcar Consulting Services, and I am the ACCA tutor, Mr. Jeremy Timkulu, and those are my credentials and my contact details. Alright, in our previous first part video to this lecture series on accounting for inventory, we touched much on the introductory part of the lecture where we looked at various inventory valuation methods. The FIFO, the first in, first out, LIFO, last in, first out, and the AFCO, average costing method, also known as the cumulative weighted average pricing method. Alright, we discussed much about that. Now we need to I promise to talk a little bit about the periodic weighted average cost method. Alright, so this is the periodic weighted average cost method we need to know. Alright, the periodic weighted average pricing method calculates an average price at the end of the period based on the total purchases in that period. So the formula for the periodic weighted average cost is cost of opening inventory plus total cost of receipts, all divided by units of opening inventory plus total units received. So in our case there, we are having a wholesaler who had the following receipts and issues during May. The receipts were these ones. Okay, these were the receipts as you can see here. Alright, and these ones were the issues, and you can see from the formula that the issues should be ignored. Alright, the issues should be ignored. So how do we calculate the value of closing inventory? For us to determine the value of closing inventory, we have to use this formula. Okay, so the cost of opening inventory, if there is any, okay, if there is an, but from the information given there is no such opening inventory, there are only receipts. So if there is no open inventory, you just have to continue with the information given about the receipts. So periodic weighted average is equal to 800 multiplied by $30 per unit, and these are the figures, the prices per unit, the cost per unit. You can see there on the last column. So this is what happened here: 800 multiplied by 30, 600 multiplied by 35, and 600 again multiplied by 40. As you can see, there are two 600s there, and then that's the 800. Okay, and you then have to divide by the units of opening inventory if there are any. In this case, there were no inventory opening inventory, so you just have to ignore, but you have to consider the units which were actually received or purchased. All right, and we are told these are the units, as you can see there. All right, so 800, 600, 600, and you can see that the cost per unit on average is $34.50, and then you have to then multiply this figure by the total of closing inventory. All right, so the closing inventory then comes into play when you do your computations. For example, in this case, let me just try to clean up the area, okay, to determine how they obtained the 400 units there. All right, you can see here that there was 800 and then we issued 400, so automatically we were left with 400, and then we added 600 here. They become 1000, okay, and then we deducted 400, we are left with 600. We add 600 there, that's 1.2. We deduct the 400. We can, all right, let me just use a pen here. We are saying we were having 800, okay, as our positive figure. Then we deduct 400, all right, the issues, which means we are left with 400, okay, and then we obtained 600. That's 600 becomes, that's plus 600, we ended up having 1000 units, and then we issued 400. Okay, then it means that we're left with 600. Okay, and then we then added 600 there, so plus 600 becomes 1.2. all right, 1.2, and then we issued 400. We also issued 400. Then we are left with 400. This is the closing stock in units. This is why you are seeing they are using the 400 multiplied by this figure per unit, and we get our 13,800. Okay, let's move on. We are done with these closing stock valuation methods. Let's now talk of the bookkeeping, the double entry bookkeeping system involved in the costing arena. Okay, in the inventory accounting arena. All right, so material held in store are an asset and are recorded in the balance sheet of the company. So when we are talking of the balance sheet, obviously we are now into the accounting. We are now tackling the accounting aspects. All right, the bookkeeping aspect of costing. Now, accounting transactions relating to materials are recorded in the material inventory account or materials control account. This is a general ledger account. All right, this is a general ledger account, and you remember from your books of original entry and books of double entry lecture which we conducted on the financial accounting module, okay, where we discussed about these things. Okay, so in this account, debit entries reflect an increase in inventory from purchases or returns to stores. So when we have an item being returned into the stores, then the material account is being debited because those items are increasing. Whenever we make a purchase, the debit entry of the materials control account is going to increase, while its credit entries reflect a decrease in inventory owing to issues to production or returns to suppliers. So you can see from this that this is the material control account, the T account, where we have the left side the debit, and the credit, the left side, the right side the credit. All right. uh, like we have just said, all increases in material inventory are considered debits because remember, uh, the assets are increased by debiting, okay, and reduced by crediting. All right. When we receive more assets, when we receive more items into the material account or into the warehouse or the stores, the materials account is being debited because those items are assets, they are being increased. But whenever we are reducing them, then we are crediting the material account. There is also an important acronym we refer to as the PLs. There is an E there. Okay. The PLs, P for purchases, A for assets, E for expenses. Okay. Then on the other side of the PLs, we've got RLS. R is for revenue or sales. Revenue or sales. This is an accounting, mainstream accounting issue, where L is for liabilities, and S items like share capital, etc. All right, that's the POS acronym, which I always teach to my financial accounting students. Okay, it might be helpful to you to understand these POS at the moment, because we are talking of assets. You can see that the first three letters of the word POS, they are increased by debiting, while the last ones are increased by crediting. So revenue or sales are increased by is increased by crediting, whereas the purchases, the assets, the expenses, they are increased by debiting. So the materials control account is for assets, because materials are assets, they are increased by debiting. This is why you see all increases in material inventory. For example, materials purchased from suppliers, they are recorded as a debit entry in the materials account because the materials are increasing. Similarly, when materials are returned from production also, they are going to increase the materials levels, they are going to increase the material account. But when we are making issues, we are crediting the materials account because we are reducing the material balances. Okay. Now, there is that question which we need to consider to test our understanding about the double entry bookkeeping system. So there is this question, ladies and gentlemen, we need to attempt to see if we are right on track. Danforth Co. issued $100,000 of materials from stores, 25% of which did not relate directly to production. So if the items did not relate to production, they were used, yes, they were issued from stores, but they were not, all of them were not going to be used for production. So actually the stores, in essence, okay, let us say materials control account, here it's a T account, we talked about it, and this is a T account. So we are told that 100,000 worth of materials have been issued from the stores. We know that the left side is the debit, then the right side is the credit, okay, of this material control account. So obviously the account should be balanced. The credit side should also record that something left out of the account. Okay, so we are going to have issues, okay, issues, okay, issues of material here, issues of materials 100,000. In terms of issues, all the items with 100,000 left the stores. So in terms of the credit side, there were issues which have been made, issues of material from the warehouse or from the stores. But on the debt side, all right, we are told that two items should or two uses. There were two uses. They were used for 75% was to production, whilst 25% was used or were used to non-production related uses. So for the 75%, we have to record work in progress, okay, which was 75% of 100,000. So obviously 75,000 was for work in progress. That's production. When you're talking of production, we are referring to work in progress. That's the technical jargon for accountants. Work in progress, that's the name of the account. And then the other non-production usage is considered as overhead, okay, as some factory overhead, okay, factory overhead, that's 25,000. Okay, all in all, we're going to have 100,000 because the total should be 100,000 on both sides. So you can see that our answer there should be C. We have to credit the material control account as we did here. We credited the material control account and debit the material control account, but with those explanations, these are the correct explanations of what was obtaining, okay, because if you simply say debit, like for example in B, the debit material control account, you did not say anything because your entry is not reflecting what is obtaining on the ground, although the credit part of it was wrong totally. All right, so what was going on, the actual reflection is found on C. All right, now let's talk of inventory control. By the end of the day, we are going to ensure that the entity, there should be no stock outs, okay, we should production should not be affected, because we have wrong materials in stock or we have run out of stocks of raw materials. Production shouldn't be affected, so there should be no stock outs. But at the same time, we should minimize inventory holding costs and also reorder costs. If we order things frequently, we are incurring what are called reorder costs. All right, but at the same time, if we want to reduce reorder costs, we have to order more things at once. But if we do so, we might end up having a lot of inventory holding costs, which is another cost we do not want. All right, so the essence of this part is for us to know what levels of inventory should we procure at a particular point in time. All right, why holding inventory? To ensure any unexpected demands can be met, thus to meet erratic demands. So if we have some buffer inventory, we would be able to attend to unknown or unpredictable eventualities. All right. Then to meet any future shortages, then bulk purchasing discounts available. We also need to capitalize on bulk purchasing discounts. Three costs involved in ordering inventory. There is purchase costs. This is the actual price we pay for the goods. All right. Then there are reorder costs. This is the cost of actually placing orders. Like for example, the lot of administrative expenses which are considered whenever we make orders, like lawyers and so forth. Then inventory holding costs. This is the cost of holding items of inventory in our storages or warehouses, in our cold rooms, etc. Those are costs we have to contend with. Now, by the end of the day, we have to minimize costs. Okay, we need to minimize costs, but we have to know which costs, which size of order is appropriate at a given point in time. All right, at a given point in time. Like I have emphasized, suppose we are ordering, let's say 500 items at a point in time or per month. We are going to have a situation like this where at each particular point we are going to have, let's say these are every month, let's say we're going to have 500 items which have to be bought. Okay, let's say this one is the time and the quantity. Okay, so let's say if we are ordering 500 units, then we're going to have a situation where we have every month we have to order, and after we order the items, they run out of stock, we order again and we sell them, we order again, we sell them, we order again, we sell them. So by the end of the day, our cost of holding the store is going to be determined as the average. Okay, so the average cost of holding the stock, the holding cost is going to be determined by the average of units which we are going to have at a particular point in time, which in this case would be 225 as the average, which is the order quantities of 50 or 500 divided by 2. All right, so let's say in a year we are going to have an average. Let's say each unit per year is going to cost us $2 to hold or to store in the warehouse. Then in a year we are going to have $500 as our cost, which is 225 multiplied by 2. If the cost of holding 1 unit of item in a particular year is $2, then in a year we're going to incur $500 if we are ordering at the order size of 500 units. But we may try to get around this figure by increasing the order. Let's say we have increased the order to 1000. Okay, if we have increased the order to 1000, then it means that our orders, okay, it means that we are going to have a situation where we have now reduced, let's say, the frequency of making our orders. To say we're now going to have this large span. Okay, maybe our orders are going now to be made after maybe 3 months or so. quantity, the time. Okay, so as usual, the average which we are going to have is going to be 500. Okay, that's we're going to have the 500 as the cost, I mean the average inventory which we'll be having. But you can see that in terms of ordering now, in terms of ordering, it means that okay, there's something here I want to emphasize. Okay, this all right, let me just say in terms of ordering costs, and then reorder costs. Okay, reorder cost is determined by the number of orders which we would have made. Okay, let's say if we were ordering 500 units per month, then, and the order was, let's say, $10 per order, it means in our first example, let's call it A, where we're ordering 500 units per month, then it means that the number of orders in a year, that's 12 orders. All right, so that's $10 by 12, which means in terms of orders, we are going to have ordering cost of 120. But in our situation B here, in our situation B, where we are now ordering 500 units per let's say here we are now ordering 1,000 units. These are now 1,000. Okay, so it means that in a year we are now ordering 6 times. Okay, that's 6 times, which means that that's in situation B, we are now going to pay the same $10 per order multiplied by 6, and you can see that our, in terms of ordering costs, are now 60. They have reduced. All right, but in terms of the holding, right, the holding costs, in terms of holding, all right, what's going on? What's going on? Oh. My computer now. All right. Now, in terms of holding costs, remember, I'm sorry, not reorder cost, but holding costs. In terms of holding costs now, the trick is we're going to use the same formula here where we say that we're going to say average inventory multiplied by the cost per unit. Okay, the cost per unit. So here the when we are ordering 500 in each order, it means that the average inventory is going to be 500 divided by 2, which gives us 225. Now if we get 225 and we say that the cost of holding 1 unit is $2 per year per annum, then that's 225 multiplied by 2 and we get 500. But in situation B now, it becomes, because we're now ordering 1000, then it becomes 1000 divided by 2, which gives us 500. All right, the 500 now. So the holding cost is equal to 500 multiplied by 2. We are going to use the same 2, and you can see that the total cost will be 1000 to hold its holding cost, and the total inventory cost now for part B will be the cost of ordering plus the cost of holding the stock, which means the total cost now is equal to 1000 plus 60, and it becomes 1060. Now for part A, the inventory holding cost was 500 and the inventory ordering cost was 120, so the total cost there is about 620. Okay, so which one is better? This is the concept. Which order level is better? This is the concept we need to understand in this particular part of the lecture. All right, so let us do an example where we'll be having a lot of options. All right, and then we'll see which one is the best order option. All right, so let me try to erase. All right, let's try to look for an eraser there. What's going on? My pen is misbehaving. Okay. Sorry, it might take a bit of time, but I want us to be fully engaged and understand where we are coming from and where we are going. All right. Okay, so we're having this question, ladies and gentlemen, where we have got 110. We have got a demand of 40,000 desks per annum, and the purchase price of each desk is $25. Their ordering cost of $20 for each order placed. Inventory holding costs amount to 10% per annum of inventory value. We are required to calculate 1/10 inventory cost per annum for the following order quantities and plot them on a graph. So that's the requirement, ladies and gentlemen, we need to contend with. All right, so let's go straight to our drawing board and see if we can make sense out of it. Okay, let's do it. That's our answer there on the board. All right, so we can as well make a table so that we see what is going on. So the order quantity, we can start with the order quantity. Okay, and then we have the number of orders, okay, and the reorder costs, and average inventory, okay, and holding costs, annum, and then we get the total inventory. Okay, total inventory cost. All right, and if we go back, let's try. We have got those. These are the inventory quantities. Okay, the order sizes. Whenever an order was being placed, those were the quantities. So suppose we were ordering the order size of 500 every time we make an order, then how would be the total cost if we're ordering 750, if we're ordering 1000, and so on. So 500, how many orders were we able to make? And remember, our demand is 40,000, right? 40,000 days a year. So that's 40,000 divided by 500. 40,000 divided by 500, we can get 8 orders. So it means in a year we placed 8 orders, because those are the orders which can be placed if we want to meet the demand of 40,000 days. All right. Now, the reorder cost. The reorder cost. We know that the order for the ordering cost of $20. So that's 20 multiplied by the number of orders, that is 8. So here that's $20 per order. That's $20 per order. So 20 multiplied by 80, we get 1600. That's 1,600. And then the average inventory, when we are ordering 500 per order, it means the average inventory is order quantity divided by 2, which is equal to 250. Okay, that's 250. All right. It reminds me something there. It means I was making an error. Okay, when we were ordering 500 units, it means the average inventory there was not supposed to be 225 but 250. That's an error. It's okay, sorry for that. Okay, now what about the holding cost, the stock holding cost? All right, the holding costs are given as you know, the cost of holding the items. All right, and we are told in the question that inventory holding cost amounting to 10% of inventory value. So the 10% of inventory value, and the inventory value is 25 per desk. So that's 10% of $25. 10% of $25, that's $250. All right. So per unit, that's $2.50. And from our earlier discussion, we said that inventory holding cost is a function of the average inventory. It is the function of the average inventory. Okay, so that's how we have to go about it. So that's 250 multiplied by 250 there. So let us try to use our calculators to see if we can make some sense out of it. All right, let me try to use my calculator here. 50 by 250, we get 625. So we get our 625, that 250 multiplied by $2.50, we get 625. Okay, so the total cost will become the reorder costs, ladies and gentlemen, plus the holding cost. That's the total inventory cost. So that's 1,600 plus 625. We get our 2,225. Then we go to the next. We did this one, so let us go to 750. Now, suppose we are now ordering an order size of 750 units per order, then the number of orders would be the demand, which was how much? 40,000 divided by 750. So that's 40,000 divided by 750, and we get 53.33 orders, and each order is at $20 per order. So the reorder cost will be 53.333 multiplied by 20, and we come to 1,067. Okay, and then what's the average inventory? Average inventory, that's 750 divided by 2. 750 divided by 2, we get 375. And the holding cost per unit, that's 375 multiplied by $2.50, because we say that holding cost is a function of average inventory multiplied by the cost per unit. So average inventory, that's 750 over 2, that's 375. 375 multiplied by 250, and we have to get our value there. Let me use my calculator. That's 938, and the total inventory cost is the reorder cost plus the holding cost, the inventory holding cost per annum. So that's 1067 plus 938. Let me use my calculator, and that gives me 2005. Then there was another order size of 1,000. Let's try this one. 1,000 units. 1,000 units, and the number of orders would be 40,000 divided by 1,000, and we come to 40. And the reorder is $20 per order. That is 20 multiplied by 40. That's 800. And the average inventory, that's 1,000 over 2, that's 500. Okay, and the holding cost per unit, that's 500 multiplied by 250, and let me try my calculator. That's 1250. And the total total inventory cost, that's reorder cost plus holding cost per annum, that's 800 plus 1250, that's 2050. Then at the order of 1,250, we can see that the number of orders there become 40,000 divided by 1250. Let me use my calculator. 4,000 divided by 1250. 1,000 divided by 1250. That's 32. All right, and the reorder cost per annum, that's $20, so 32 multiplied by 20, that's 640 obviously, and the average inventory, that's 250 plus divided by 2, that's 625. Then the holding cost per annum, that's 250 multiplied by 625. Let me use my calculator. 625 multiplied by 250, that's 1563. Then we have to add up 640 plus 1563, which are the reorder cost and holding costs respectively. Then we get our 22.03. So the question is now, which order quantity was fine or should be fine? You can then make that decision based on the total inventory cost on the last column here. So you can see that this should be the best order option. That's, we have to order 750 each time. An order size of 750 is actually economic because it has got a total cost which is lower than the rest of the options. Okay, I think there we have a good explanation, but we are required also to come up with some pictorial view of what would be going on. So we need some sort of graph to understand better what we are talking about. Okay, some graphical depiction of what we have been talking about. All right, so let's have something like this one. We've got our dollar sign, and we have some order quantity here. All right, which order quantity is the best one? We have seen above there that the more we increase the order, the more the ordering costs were getting lower. As you saw here, the larger the size of the order, the lower the ordering costs. They become lower by the day. Let me try to use different pen. Okay, they were getting lower, as you can see here. The larger the order, because the orders were increasing, as you can see also, but you could also see that the reorder costs were decreasing. So ordering costs are decreasing, tend to decrease. So the ordering costs tend to decrease as the order quantities. You can see these are the order quantities. This axis is for the order quantity. As the axis, as they are increasing, that's the increase in order quantities. You can see that the ordering costs were decreasing. You can see that that's a decrease of the ordering costs. They were decreasing. Okay, ordering costs were decreasing. Now, what about the holding costs? What about the holding costs? The holding costs are like an equation of y is equal to x, okay, or the some demand curve, okay, some supply curve. You can see that more quantities are supplied if the order or if the price increases, suppliers continue to supply more. Okay, if at a higher price, the higher the price, the more the supplies, something like that. So but we're not talking of the supply curve in this case. Let's talk of the ordering here. You can see that the higher the orders, the more the orders were increasing in size, the holding costs tend to increase. So this is actually the holding cost graph. Okay, holding cost per annum. All right, now so you can see that there was a certain the tendency here was that as you can see from these figures, you can see that there was at a certain order size, the total price was 2,225. All right, but at 750 the price had lowered to 2,005, but it started again to increase when we were ordering 1,000 and continued to increase when we were ordering 1,250. So that tendency that the total cost, this is the total cost section, that's the total cost column. So that behavior is represented by this graph, where at some point the price will be minimum but tend again to increase. That's the total cost graph, total inventory costs. So which one now is the optimum order size? The optimum order size is at this level, where the total cost graph is lower. The point at which the graph is lower, that's the optimal quantity. Okay, that's where our 750 was. Okay, the 750 quantity there was at this point. All right, and if we go, this is the cost. Okay, that was the 2005. That's where the cost was. Okay, I hope there, ladies and gentlemen, you have understood what we referred to as the best order size. But there is an easier way to do all this. We have got an economic order quantity formula. This is given in your exam if studying ACCA. Okay, the ACCA MA paper. This formula is given. If you are studying management accounting with the ACCA, they give you the exams, the formula. But if you are studying other examinations, or maybe in a Bachelor of Accounting degree, probably your university is not going to give you, but that's not worry. By the end of this lecture, you should have the formula at your fingertips. All right, ladies and gentlemen, that's the formula we are referring to here. All right, the economic order quantity is the reorder quantity which minimizes the total cost associated with holding and ordering stock. Holding costs plus ordering costs are at a minimum at the EOQ. So when you are talking of the economic order quantity, it means that the holding costs and ordering costs are at minimum. All right, that's it, ladies and gentlemen. So the EOQ is equal to T COD over CH, where D is the demand per annum and CO is equal to the cost of placing one order, and CH is equal to the cost of holding one unit for 1 year. All right, those are the assumptions, ladies and gentlemen. You can read on your own. Now, the economic order quantity formula, for the information given, in example on cost minimization, the example which we have just done or did, use the EOQ formula to calculate the economic order quantity and calculate the total inventory cost for this order quantity. And this is how you are supposed to calculate the economic order quantity, ladies and gentlemen. All right, that's the formula there. It's so easy to just grasp everything. All right, and the reorder cost now becomes 4,000 divided by 800, which is equal to 50 orders multiplied by $20 per order. Because if you still remember, the in our example, the order was the cost of placing the ordering cost of $20 per order placed. Okay, so this is the same concept which was applied here. So you can see this is why we obtain the 1,000. Then inventory holding cost, that's the average inventory. Remember, if we are now ordering 800, the average is 800 over 2, that's 400 multiplied by $2.50, and we get 1,000. So the total inventory cost becomes 2,000. Now, what happens when discounts come into play? The thing you have to do is you need to breathe and relax. You just have to calculate the EOQ, ignoring the discounts. If it is below the quantity which must be ordered to obtain discounts, calculate the total annual inventory cost as normal. Recalculate total annual inventory cost using the order size required to obtain the discount. Then compare the cost of step 2 and 3 with the saving from the discount and select the minimum cost alternative. Sometimes you might be given a discount, but you discover that there was no actual saving. So you need to actually evaluate the cost versus benefit and option. Then repeat for all discount levels. All right, that's how you have to navigate the territory. Now let us see if there is an example. Yes, there is. Now, for the information given in example on cost minimization, the supplier now offers us discounts on purchase price as follows. We are having this order quantity and the discount, and we are told that from 0 to 5,000 to less than 5,000, that is to 4,999, there is no discount, there is a 0. But any order from 5,000 to less than 10,000, that is at 9,999, there is a 1% discount. And then we have a 10,000 or over at 1.5% discount. Now calculate the economic order quantity. That's the requirement we have to consider. Now, we know that the economic order quantity, okay, was 800 units. That's the starting point. Now 800 units are within this range, so there is no discount that should be expected. So if we are ordering at 800 units per order, we have no discount. So what happens is that we just have to say the purchase cost is the 40,000 units ordered multiplied by the price per desk, which was $25. So automatically we are going to have, hello mom, can you take the daughter here? Okay, daughter, I'm busy. Okay, just sleep. I'm sorry guys, okay, so we are going to have 1 million. Okay, we're going to have 1 million. My daughter wants to play with daddy. All right, and then we have got inventory. Okay, inventory costs. We're going to have the inventory cost. Um, these have been calculated as 2000, if you still remember. Okay, the total inventory cost was 2000, as you can see here. That's 2000. So uh, so if we have to add up, that's a 1,000,000 and $2,000. Okay. Now, what about at the order quantity of 5,000? At the order quantity of 5,000, we are going to have some discount of 1%. Okay, thus the discount would be 1% at that quantity. Okay, so let's use this space here. All right, so order quantity is now 5,000 units. All right, when the order quantity is now 5,000 units, we are entitled a discount. So the purchase cost becomes 40,000 units multiplied by the price we are going to pay. That's 99%, because there is a discount of 1% multiplied by $25 per desk. All right, $25 per desk, and we have to use our calculators, ladies and gentlemen. Let me try to punch my figures there. 40,000 multiplied by 0.99 multiplied by $25. That's 990,000. Okay, then we have to worry about the inventory cost. These ones we have to calculate now. Inventory cost. All right, the inventory cost is made up of the reorder cost as well as the holding cost. So reorder cost. The reorder cost now, ladies and gentlemen, we are ordering at 5,000, so that's 40,000 demand divided by 5,000 to determine number of orders. Okay, which means we are having 8 orders at how much per order? We know that the order was $20 per order from this. Go back, let us go back here, ladies and gentlemen. We know that we were ordering at $20 per order. All right, so that's $20 per order. So we are going to have a situation where we are having 160 is our orders, the reorder cost. Then what about holding cost? Inventory holding cost. I said that holding cost is a function of average inventory, which means that we are ordering 5,000, so 5,000 divided by 2, that's okay. Let me just say 5,000 over 2, okay, which becomes 2,500 multiplied by $2.50. If you still remember, it was $2.50. Okay, but we have to remember to multiply by the percentage discount factor there. So you can see that we are going to have, let me punch my figures. That's 2,500 plus 250. This figure 250 multiplied by 0.99. That's we're going to have that's 6,188. I need the light. So you find me using the light. Okay, maybe you disturb it. Doesn't fair. Okay. Then we get this total. Okay. So let us punch these figures here. 990,000 plus 160 plus 6,188. We have to get our 909 6 calculate of 9. Okay, 348 per annum. That's the total figure that we have to incur. But at the order quantity, let's say of order quantity, when the order quantity becomes let's say 10,000 units, the purchase costs is going to be adjusted by a 1.5% discount. So it means that we are going to have 40,000 multiplied by 98.5, because we have to deduct 1.5% discount from 100%. So we're going to have multiplied by $25 per unit per desk. So we're going to have the total cost here of 985,000. We are also going to have the inventory costs. Inventory costs, and I said reorder costs. The reorder cost, that's 40,000 divided by 10,000. That's the order size now, which is equal to 4 multiplied by 20 per order. That's 80. All right, and then we've got holding costs. Holding cost of 10,000 divided by 2. This gives us 500 multiplied by 250 multiplied by the 98.5%, and we have to get what is called the 12,313. We then have to add up okay. Sorry. Okay. Let me just try to cross check this last value here. Let me just try to punch my calculator again. This is 5,000, not 500. Okay, that's 5,000 multiplied by 250 multiplied by 98.5. Okay, so I'll get this value right. So that was okay. So let us add up 985,000 plus 80 plus 12,313 and 85,000 plus 80 plus 9 times plus 12,313. That's 997,393 per annum. So you can see that these are the figures which we obtain. All right. So basing on the three figures which we have obtained, the first total cost was this one, 1 million. and $2,000 when the order was 800 units. Okay, if we use 800 units, it means that the order, the total cost would be $1 million and $2,000. But when the order becomes 5,000, the total cost will become $996,000. When we increase the order to 10,000, even if there is a discount of 1.5, the cost would be higher, will start to go up again. But here at 5,000 units, they had become lower to 996,340. So you can see that the best option is to use the order quantity of 5,000, which is this one. Okay, so the 5,000 leads us to a much lower total cost as compared to the other options. Okay, sure, we are done there. We can proceed to the economic batch quantity. The economic batch quantity is a model primarily concerned with determining the number of items that should be produced in a batch compared to the size of an order with the economic order quantity. So the formula is also given there. All right, so it's usually used when we want to know how much batches are we going to produce at a given time, or in what batches are we going to produce the items. All right, so this is the formula for the economic batch quantity, where the Q is the batch size, then D is the demand per annum, and CH the cost of holding 1 unit for 1 year, then CO the cost of setting up a batch ready to be produced, and R annual replenishment rate. It is also worth learning that the average inventory level in this situation would be average inventory is equal to ABQ over 2 and adjusted by 1 minus D over R. Note that this formula will not be given even in the ACCA exam. There is no such a formula to be given. So what is required? You have to memorize this formula by head. Sorry. So we need to memorize it. Otherwise, we are going to fail. Okay. So there is that question there where we are required to do some computations. AB Limited makes a component for one of the engines that it builds. All right. It uses on average 2,000 of these components steadily throughout the year. The component costs $16 per unit to make, and it costs an additional $320 to set up the production process for each time a batch of components is made. The holding cost per unit is 10%. Okay, it's 10% of the unit production cost. The company makes these components at a rate of $200 per week, and the factory is open for 50 weeks per annum. Required to calculate the economic batch quantity. So let us try to drive the EBQ formula. All right, so let us have the EBQ formula first. All right, we know that EBQ is equal to root 2COD. So this one is actually a gigantic root, okay, and 2COD. So you can see that the numerator part of it is the same as this economic order quantity numerator. So there is also the CH was taken as it is, and then there is only this adjustment factor D over R. Okay, and that's, this one is CH, don't confuse it as an L. Okay, so let us find the variables in this scenario. Okay, so what was our D in the scenario there? AB Limited makes a component for one of the average of the engine that it built. It uses on average 2,000 units. So you can see that that's our D there. So our D comes 2,000. Then let's find our error. Let's try to find the error. Okay, the error, we are told here that the error is the annual replenishment rate. Okay, the annual replenishment rate. So the component costs $16 per unit to make, and it costs an additional $320 to set up the production process each time a batch of components is made. The holding cost per unit is 10% of the unit production cost. Okay, the production cost. The company makes this component at a rate of 200 per week, and the factory is open for 50 weeks per annum. So each week we make these components at the rate of 200 units or 200 components per week, and we have got a 50-week year. We have got 50 weeks in a year, so the replenishment rate should be 200 multiplied by 50, which gives us 10,000. Okay, and we also need to determine the other variables there, the CO, the CH. We need to know those ones. The CO, that's what is the CO from this one? CO is the cost of setting up a batch ready to be produced, and we are given that value, the cost. The component costs $16 per unit to make, and it costs an additional $320 to set up the production process. So this is the cost we need, because we are told that's the cost of setting up a batch here to be produced. So that's 320. CO is equal to 320. What about the CH? The CH. What is CH? CH is the cost of holding one unit for 1 year. So that's the CH, which is, so CH was never modified from the original EOQ formula. So CH, the cost of holding one unit, which is given in our scenario. The company costs $60 per unit to make, and it costs an additional $320 to set up the production process each time. The holding cost per unit is 10% of the unit production cost. So the unit production cost, we are told that is 16. The component costs $16 per unit to make. So we are told that the cost of holding this unit is 10% of its manufacture price. So that's 16. That's 10% of 16, which becomes $60. So we've got our D, our R, our CO. We can safely now use the EBQ formula, which is equal to root 2 CO. We've got our CO, that's multiplied by 320, multiplied by D, and D is 2000. Okay, D is 2000 divided by our CH, which was $60, multiplied by 1 minus D, which is 2000, over R, which was 10,000. And we need to determine, let us use our calculators, ladies and gentlemen. Obviously, we have to get 1000 units. If you get another figure, then you have to make sure you obeyed the law of brackets and everything else, and also know that everything else is within this root. This root is actually a gigantic root. Everything else is within this square root. Okay, I'm sure there we are done. We can also use take this example as a further practice question. All right, and we know we have the formula with us. Okay, we have the formula with us, and we at this level we can safely write the formula quickly, and we say that this is 2COD over CH 1 minus D over R. That's the formula, ladies and gentlemen. But what is important is to be able to link the formula, or to fill to determine the variables from the scenario which you have been given, and slot those variables into the formula. Okay, so let's read. A company's demand for 50,000. So you can see that our D has been found. Okay, this is our D. All right, that's our D. They produce their own units at a cost of $30 per unit. The cost of making the unit has been found. All right, at the cost of making the unit of $30. All right, that figure is important when we want to determine the cost of holding one unit. Okay, is usually linked to the cost of producing the unit, and are capable of producing at the rate of 500,000 units per annum. This is our R. So that's our R. The 500,000 is our R. Machine setup costs are $200. This for each batch. That's our CO. Okay, our CO is 200. That's the CO. Inventory holding costs are 10% per annum of inventory value. So you can see that this is where we get our CH. Okay, we link the CH and the 30 to get, we link the 10% and the 30 to get the CH. So CH, that's 10% multiplied by $30, and we get our $3. Okay, what about our CO? CO is given as $200. D is given by 50,000, and our R is given by 500,000. So the EBQ becomes this root, okay, the square root of 2 multiplied by $200 multiplied by 50,000, all over CH, which was $3 multiplied by 1 minus which is 50,000 for over 500,000, and we need to punch our calculators correctly, ladies and gentlemen, to obtain some value there. And this value, let me just try to punch these figures. Ladies and gentlemen, you must make sure that you have got a good serviceable calculator when you enter into these exams. Okay, do not be a Jewish prophet. Do not tempt examiners by becoming a Jewish prophet. You might end up being a suicide case. So we need to be very careful and have good calculators so that we make hay while the sun shines. All right, so that's 722 units. But remember, we are not yet through, because the question says calculate the economic batch quantity and the cost involved per annum for that quantity. So we've done the first part. Let us do the last part of it. Okay, we then have to consider issues to do with the reorder costs, the annual holding costs of the inventory holding costs, because if you do not calculate those ones, then we haven't done anything, ladies and gentlemen. So we need to actually go back to the question and see what would be going on. All right, so ladies and gentlemen, let's start calculating the reorder cost. Okay, let's calculate the reorder cost. Reorder costs, these ones are also, they're just the same. They are called setup costs as well. Okay, they can be called setup costs. In this case, in the batch economic batch quantity case, we call them setup costs. Okay, setup costs, which we have to determine them. The way we do the reorder costs, the reorder quantity, the reorder costs, where we say that we need to know the number of orders. All right, in this case, our orders were the demand was 50,000. Okay, the demand is 50,000, but we are ordering this. Okay, this is our economic order quantity, but it's a batch quantity. Remember, economic batch quantity, but we're going to use the same principle as from the economic order quantity. All right, so we're going to say 50,000. Let me just, okay, reorder costs. We're going to say number of orders is equal to the demand, which was 50,000. Okay, the demand was 50,000 divided by the economic batch quantity of how much we obtained, 2,722. And let us use our calculator. It should be something like 18.37 orders. Okay, these are the orders. Then after we do that, we then have to go to the setup costs, the reorder cost, or setup costs. Okay, the setup cost, ladies and gentlemen, which becomes the number of orders, 1837 orders, multiplied by the cost per order. In this case, the cost per order is the machine setup costs are 200 for each batch. So that's $200. And we get let me just punch these figures in this calculator. um, that's 3674. All right, we are done. Then let's think of the holding costs. Holding costs, ladies and gentlemen. Holding costs, we say that this is a function of average inventory. All right, so that's what is the average inventory is based on the economic order quantity, but in this case we are using the economic batch quantity and divided by 2. Economic batch quantity was 2722, so 2722 divided by 2. Okay, but remember we have to adjust. This is why we were given this formula. Average inventory is economic batch quantity divided by 2 multiplied by 1 minus D over R. Okay, 1 minus D over R. So multiplied by 1 minus D over R, and this becomes 2722 over 2 multiplied by 1 minus our D was if you still remember, our D was 50,000 over 500,000. Okay, so if we use our calculator, ladies and gentlemen, nicely, we must get this 24.90. That's the average inventory. Now, if we have got the average inventory, then the annual holding cost, the inventory holding cost, should be 1224.9 multiplied by this one was determined here. Remember the CH, that's the holding cost per unit, is $3. Okay, so multiply by $3, and we have to get what is called 3,675. So we have to use these two costs. Okay, this is the inventory holding cost, okay, and the reorder cost of, to get the total cost. All right, the total inventory cost, inventory is equal to 3674 plus 3675, and we have to get our total of 7349 per annum. Ladies and gentlemen, these were the computations which were required. Now we need to just talk a little bit about the reorder levels, separate inventories, etc. All right, reorder level, this is when inventory held reaches the reorder level. When inventory held reaches the reorder level, then a replenishment order should be placed. Okay, we've got a term called lead time. This is the time expected to elapse between placing an order and receiving an order for inventory. So the time when you place an order and the time is expected to lapse between that time you place an order and receiving the order. That's what we call the lead time. Then we have got the reorder quantity. All right, when the reorder level is reached, the quantity of inventory to be ordered is known as the reorder quantity or the economic order quantity. Then demand. This is the rate at which the inventory is being used up. It is also known as inventory usage. If the demand in the lead time is constant, the reorder level is calculated as follows. Reorder level is equal to, when demand in lead time is constant, is equal to usage multiplied by lead time. Okay. So these formulae are important. Reorder level is equal to maximum usage multiplied by maximum lead time. Minimum level is equal to reorder level minus average usage multiplied by average lead time. Maximum level is equal to reorder level plus reorder quantity minus minimum usage multiplied by lead time. Average inventory is equal to average, buffer inventory plus half reorder quantity. Okay. Let us see if there are still other examples for us to illustrate these points. All right. A national chain of tire fitters stocks a popular tire for which the following information is available. Usage is 175 tires per day. Lead time 16 days. Reorder quantity 3,000 tires. Based on the data above, at what level of inventory should a replenishment order be issued in order to ensure that there are no stock outs? So here we need to determine the reorder level. All right. So let me try to get on the pen. Reorder level. Okay, reorder level, we saw that the reorder level was maximum usage multiplied by maximum lead time. So reorder level is equal to maximum usage multiplied by maximum lead time, which is equal to maximum usage, that's 175, and maximum lead time, that's 16. So 175 multiplied by 16, which gives us 175 multiplied by 16. Calculate of mine. It's 2,800 tires. Okay. A company is a demand from customers of 1,000 units per week. The time between placing an order and receiving the goods, the lead time is 5 weeks. The company has a policy of holding sufficient inventory of 100 units. What should the reorder level be? In this case, we need to know the initial reorder level. Okay, and initial reorder level is equal to the demand, okay, over the lead time. Okay, which is equal to 5 multiplied by 5 weeks. Okay, 5 weeks multiplied by 100 units per week, which is equal to 500 units. Okay. The company is a policy of holding sufficient inventory of 100 units. Okay, so sufficient inventory is equal to 100 units. So that's the reorder level now should be 500 plus 100 units, which is equal to 600 units. Okay, reorder. So You can see that it's all about understanding what is going on, and you articulate yourself to something that makes sense. All right. So you need to show the examiners that you are ready to go to the next module by articulating the data given. Okay, ladies and gentlemen, I hope you have enjoyed this presentation. If you still need more coaching, or you need a tutor within your accounting studies or finance, I am here. I am ready 24/7. Please just engage me. If you have found this video helpful, don't forget to share it with your friends, to like it, share it, and subscribe. Don't forget to subscribe and click the notification bell for new videos, because we always put videos on this channel which are related to accounting and finance, so that you stay blessed. You are groomed to become a qualified accountant, to become a financial expert, uh, and everything else that goes incidental to this field of accounting and finance. Ladies and gentlemen, I'm Jeremy Timkulu. Once again, I am signing out. Goodbye. Wait.